Understanding Business Financial Statements, a crash course. Understanding Business Financial Statements, a crash course. Financial statements are a critical tool for any business. They provide an accurate picture of a company's financial health, which is important for making sound business decisions. However, for many business owners and managers, reading financial statements can be a daunting task. Fortunately, with a little bit of knowledge, anyone can learn to understand financial statements. This article will provide a crash course in understanding the various financial statements that a business must generate in order to keep track of its finances. The main types of financial statements that a business will produce are the balance sheet, the income statement, and the cash flow statement. Each of these statements provides a unique view of a company's financial health, and reading all three in conjunction is critical for a complete understanding of the company's finances. The balance sheet. The balance sheet provides a snapshot of a company's financial position at a single point in time. Specifically, it shows a company's assets, liabilities, and equity. This statement is called the balance sheet because the values of the assets must equal the values of the liabilities and equity. Assets are resources that a company owns that have economic value and can be used to generate future profits. Typically, assets are divided into two categories: current and non-current. Current asset S include things like cash, accounts receivable, money owed to the company by customers, and inventory. Non-current assets include things like property, plant, and equipment that a company owns. Liabilities are obligations that a company owes to others. Like assets, liabilities are divided into current and non-current liabilities. Current liabilities include things like accounts payable, loan that a company owes to vendors, short-term loans, and other obligations that must be paid within a year. Non-current liabilities include things like long-term loans and other debts that must be paid over a longer period of time. Equity represents the ownership interest in a company. It is equal to the value of the company's assets minus the value of its liabilities. Equity can be represented by a variety of financial instruments, including common stock, preferred stock, and retained earnings. The key takeaway from the balance sheet is that a company's assets must equal liabilities plus equity. This is known as the accounting equation and is one of the fundamental principles of accounting. The income statement. The income statement, also known as the profit and loss statement, shows a company's revenues and expenses over a period of time. The purpose of the income statement is to show how much profit a company has made during a specific time period. The income statement is divided into two sections: revenues and expenses. Revenues are the money a company earns from selling its products or services. Expenses are the costs associated with running the business. This includes things like the cost of goods sold, wages paid to employees, and rent. The bottom line of the income statement is net income, which is the amount of profit a company has made during the period covered by the statement. A positive net income means that the company has made a profit, while a negative net income indicates a loss. It's important to note that the income statement only shows revenues and expenses that have been incurred during the period covered by the statement. This means that some revenues and expenses may not be reflected in the income statement. For example, if a company receives payment for a service that will be provided in the future, that revenue will not be reflected in the income statement until the service is provided. The cash flow statement. The final financial statement that a business will generate is the cash flow statement. This statement shows the inflows and outflows of cash during a specific time period and is distinct from the income statement. While the income statement shows revenues and expenses, the cash flow statement shows cash flow movements. The cash flow statement is broken down into 3 sections: operating activities, investing activities, and financing activities. Operating activities include the cash received and paid by a company as part of its normal business operations. Investing activities include cash flows related to the purchase and sale of long-term assets, such as property and equipment. Finally, financing activities show the inflows and outflows of cash related to financing, such as loans or the issuance of stocks. The bottom line of the cash flow statement is the net increase or decrease in cash during the period covered by the statement. This is a critical figure, as it indicates whether the company has enough cash to cover its expenses and invest in the future. Putting it all together. Reading financial statements can be overwhelming, especially for those new to business finance. However, by understanding the fundamental principles of each statement, it is easy to put them together. To gain a complete picture of a company's financial health. For example, if a company has a positive net income on its income statement, this may be a sign that the company is in good financial health. However, if the cash flow statement shows that the company is running low on cash, the positive net income may be misleading. Similarly, if the balance sheet shows a large amount of debt, this may be cause for concern, even if the income statement shows a positive net income. Ultimately, understanding financial statements is about putting all the pieces together to gain a complete picture of a company's financial health. By learning the basics of each statement and how they relate to each other, anyone can become proficient at reading and analyzing financial statements. In addition to understanding the basics of each financial statement, there are a few other things to keep in mind when analyzing a company's finances. One important factor is the context in which the financial statements are presented. For example, a company's financial statements may look very different depending on the industry in which it operates. It's important to take the industry context into account when analyzing financial statements. Another factor to consider is the timing of the financial statements. Financial statements are typically generated on a quarterly or annual basis, but they may not always be up to date. It's important to consider whether the financial statements are current or whether they may be outdated. Finally, it's important to consider any external factors that may affect a company's financial health. For example, changes in the economy, regulations, or other external factors may impact a company's finances. By staying up to date on these external factors, it's possible to better understand a company's financial position. By keeping these factors in mind and learning the basics of financial statements, anyone can become proficient at understanding a company's finances. While it may seem daunting at first, with a little bit of practice and knowledge, anyone can become a pro at reading and analyzing financial statements. Furthermore, those who become proficient in this area can help their companies make informed decisions that can set them up for long-term success. So, if you want to improve your skills in reading and analyzing financial statements, there are plenty of resources available to help you. Many business schools offer courses in accounting and finance, statement analysis, and there are a variety of online resources, such as tutorials and webinars, that can help you improve your skills. It's also important to remember that financial statements are just one aspect of a company's financial health. While they provide a vital picture of a company's finances, they don't tell the whole story. It's important to also consider other factors, such as market trends, competition, and the overall economic climate when making business decisions. In addition, it's important to work with an experienced accountant or financial professional who can help you make sense of financial statements and provide guidance on key financial decisions. With the help of these experts, you can gain a deeper understanding of your company's finances and make sound decisions that can set you up for long-term success.